All right, some big news just dropped from the IRS for all you retirement savers out there. They've officially announced the new numbers for 2026, and the headline is, "You can save more than ever before." So we're going to break down exactly what these new higher contribution limits mean for your financial future.
So the real question is, are you ready to actually take advantage of these changes? Maximizing your retirement contributions is one of the best things you can do for yourself financially. So let's dive right in.
Okay, first up, the big one. For 2026, the contribution limit for most workplace plans, we're talking your 401k, 403b, even the federal thrift savings plan, it's jumping up to $24,500. That's a full $1,000 increase from the year before. And just think about what that extra $1,000 a year really means. With even modest growth over, say, 20 years, that could easily be an extra $30,000, maybe even $40,000 waiting for you. Not bad. And hey, it's not just your workplace plan getting a boost. The limit for personal IRAs, that's both traditional and Roth, is also on the rise. For 2026, you can now sock away up to $7,500. That's another solid $500 jump. Okay, so those are the big headline numbers, and they're great. But honestly, the real power is in the details. The rules about who can contribute, how much you can deduct, and these special catch-up rules, that's where you can really optimize your whole strategy. So here's our roadmap for this explainer. We'll kick off with why these numbers are changing, then get into the nitty-gritty of workplace plans and personal IRAs. We'll also cover the special rules for super savers over 50, tackle those all-important income limits, and wrap it all up with a simple action plan for you for 2026. All right, let's get into it. Section 1, the 2026 retirement refresh. So, why do these numbers go up in the first place? It's actually pretty straightforward. Every year, the IRS makes these cost of living adjustments. It's their way of making sure your savings power keeps pace with inflation, so the real value of your hard-earned money doesn't get eaten away over time.
Okay, next up, let's talk about powering up your workplace plan. This is all about what you can do with those employer-sponsored accounts, like your 401k.
So, as you can see, for the most common plans, your 401ks, 403bs, and so on, we're seeing that awesome $1,000 jump to $24,500. And if you have a simple plan, you're not left out. You get a nice bump too, up $500 to $17,000 for 2026. All right, moving on to Section 3, boosting your personal IRA. I love these accounts because they're the ones you control directly. And honestly, the new limits for 2026 make them even more attractive. Now, when it comes to IRAs, the big question is always traditional or Roth. And honestly, the simplest way to think about it is this. Do you want to pay taxes now or pay taxes later? With a traditional IRA, you might get a tax deduction today, which lowers your tax bill right now. The catch? You pay income tax when you take the money out in retirement. A Roth IRA? It's the complete opposite. You put in after-tax money, so no deduction today, but your qualified withdrawals in retirement are 100% tax-free. Pretty sweet. All right, this next part is for the super savers. If you are age 50 or older, listen up, because the IRS gives you a special superpower to accelerate your savings as you get closer to that retirement finish line. And this superpower is called a catch-up contribution. The name says it all, really. It's just an opportunity to put in an extra amount of money right on top of the standard limit, designed specifically for savers who are 50 and up. And believe me, these catch-ups can be a total game changer. For 401ks, the standard catch-up for those 50 and over is now $8,000. But get this, there's a special, even bigger provision for those aged 60 to 63. Your catch-up limit is a massive $11,250. For IRAs, the catch-up is now $1,100. And for simple plans, it's a very helpful $4,000. Okay, so let's just add that up for a second. If you're 50 or older, you can put in the standard $24,500 into your 401k plus that $8,000 catch-up. That brings your grand total to $32,500. That's how much you can potentially put away in your workplace plan in a single year. What a massive opportunity. All right, on to Section 5, the rules of the road. Because look, while these new limits are absolutely fantastic, there's a catch. Your income plays a huge role in your eligibility for some of these benefits, especially when we're talking about IRAs. The magic number you need to know here is your modified adjusted gross income, or MAGI for short. Don't let the name scare you. Just think of it as your total income, but with a few specific deductions added back in. The IRS uses this number to figure out if you can contribute to a Roth IRA or deduct your traditional IRA contributions. So here's how it works for Roth IRAs. It's all about your income. If you're single and your MAGI is below $153,000, you're good to go. You can contribute the full amount. But once your income hits that phase-out range, which goes up to $168,000, the amount you can contribute starts to get smaller and smaller. And if you're above that top number, you can't contribute directly. For folks who are married and filing jointly, that range is between $242,000 and $252,000.
Now, for traditional IRAs, the rules are a little different. See, anyone can contribute, no matter your income. The question is whether you can deduct that contribution. And that depends on your income, but, and this is a big but, only if you're also covered by a retirement plan at work. So if you're single and have a 401k, for example, that deduction starts to phase out at $81,000. For a married couple filing jointly, that phase-out range is between $129,000 and $149,000. Woof, okay, we've covered a lot of ground. So in our final section, let's boil it all down into a simple action plan and highlight the key numbers you really need to remember for 2026. Okay, so if you remember nothing else from this, remember these 4 key numbers. The standard 401k limit, $24,500. The standard IRA limit, $7,500. And if you're 50 or older, your 401k catch-up is a cool $8,000, and your IRA catch-up is $1,100. These are the numbers to build your 2026 savings plan around. So now you've got the new numbers. You know the rules. The only question left is, what's your first move? Are you going to bump up that 401k contribution percentage? Maybe finally open up that IRA you've been thinking about? Or is this the year you take full advantage of those catch-up contributions? The opportunity is all yours.